Welcome back. Today we're looking at a report on that recent 8.61% surge in Beyond Meat. It's all about the clash between weak fundamentals and these wild speculative forces.
And let's jump right in. The biggest opportunity here, I think, is really in the strategic structure of your analysis.
Okay.
That's exactly where the biggest narrative opportunity lies. I wonder if we've considered how these two competing forces, the immense speculative rush and that massive convertible debt overhang, are actively, fighting, not just sort of existing in parallel.
Right, we're talking about the 2030 notes conversion, that potential influx of, what is it, up to 120 million new shares.
Precisely. And the weakness here is that the report presents this massive dilution risk as, well, as just a separate element of the bear case. It's not framed as a tactical weapon that short sellers can actually deploy against the bulls.
So it feels a bit disconnected.
Completely. The suggestion is to really strengthen that connection between the dilution risk and the short squeeze dynamic. You need to maximize the tension. Show how that potential flood of shares acts as a tangible liquidity overhang that shorts can exploit in real time.
And a concrete example of that?
You could reframe this dilution as the short seller's safety net. For instance, you could discuss how 120 million potential new shares introduce immediate supply, making it incredibly difficult for retail buyers to sustain that short squeeze momentum. It effectively acts as a guaranteed volume ceiling.
Okay, and building on that idea of structural tension, let's talk about pacing. The report, it opens really strong with the 8.61% gain, that wild 36% intraday swing.
Yeah, it definitely grabs you.
It does, but the pacing kind of undercuts its own impact. It delays the most critical strategic point, the extreme short interest, all the way until part two.
So the reader doesn't immediately get why that 8.6% move is so significant.
Exactly. They don't understand the why right away.
Got it. It's about front-loading the context. So we'd suggest introducing the key antagonist, that 40.6% short interest, immediately, right there in part one.
And by framing the gain that way.
By framing it within the context of that extreme short positioning, the reader instantly understands why the 8.6% move is an explosion and not just another volatile day for a meme stock.
Right. So for a concrete improvement, in part one, when you're discussing the reasons for the spike, you could lead immediately with that statistic. Something like, the spike is attributed to extreme short interest, 40.6% of the float, making it a prime candidate for a short squeeze.
And then you can pivot naturally into the discussion of meme stock volatility. It just sets the stage so much better.
Okay, so we've nailed the structural flow.
But if we dig into the bear case itself, I feel like something is missing. The case is robust. It cites the analyst downgrades to $1, the weak Q3 outlook, but the analysis of the dilution risk, it just lacks the necessary psychological punch.
It treats the November 14th conversion announcement as just another factual risk.
Yes, and here is the golden narrative opportunity. That announcement happened on the exact same day as the speculative buying frenzy.
That's how you maximize the psychological drama of the bear case.
That's right. We suggest explicitly leveraging the precise timing of that dilution announcement. You have to underscore the cognitive dissonance for the speculative traders. Highlight that the company delivered the worst fundamental news you could imagine, massive, highly dilutive risk, at the same time as the sheer madness of that retail surge.
It becomes a true clash of wills.
A true clash of wills. To really realize this, stress that the announcement of 120 million potentially dilutive shares acted as a direct, real-time countersignal to all that retail enthusiasm. It frames the whole No 14th trading session as this incredible battle between raw market mechanics and cold corporate finance.
So, to quickly summarize the most actionable suggestions, first, integrate the dilution risk into the short squeeze analysis. You need to treat that convertible debt as a tactical defensive weapon.
Second, front-load that key 40.6% short interest statistic into the very beginning of part one. That immediately establishes context and increases the narrative pull.
And finally, emphasize the profound psychological drama. The fact that the dilution news dropped at the precise moment of the speculative rally is it's the core of the story.
Exactly. These are high-level, structural, and I think dramatic changes.
So implement these revisions to maximize the tension and narrative power of your report.
And when you do, please submit the refined material back to us.